Hi, I'm Phil Grandy at philsgang.com, my YouTube channel, and also my radio show, philsgang.com. During this recording, please hit subscribe, like, and share. I would really appreciate it. Also, anytime during the recording, you can go join my gang, philsgang.com. Go to where it says Get Started, and you become a working investor for 10 days free, where you'll learn how to sell short finally. All right, so here we are, the day before Christmas. Thanksgiving. I'm rushing it a bit. And I told my members that we are going to go ahead with the start of earnings season and buy the spider. Because you always make money buying the spider during earnings season because they rig the market to go up because they beat their own estimates. It's pretty simple, all right? And I've been noticing they're now into retail earnings, and they're telling how great retail is. And they're saying how, wow, retail come in very strong. They're beating their estimates, which means the consumer's strong. Well, that's a bunch of nonsense. First, they're beating their own estimates. And who sets their own estimates? Their CFOs. Of course they're going to beat their own estimates. And the consumers, no, they're not strong. They're in really bad shape. Remember, they increased their savings by 32% during the pandemic. Why? Because Biden, of course, a socialist, gave the house away. They didn't have to pay rent. They didn't have to pay their student loans. I mean, you kidding me? $1,400 checks, paid their utilities for them, on and on and on. So they had 32% an increase of 32%, I'm trying to say. So, but they went through all that money. The savings now is up just 3.1%. That's quite a drop. So why are they saying they're strong? Well, because they still have their credit cards. That's right. They're purchasing on their credit cards. They're purchasing debt. And I don't know why they call it a credit card. It should just be a red flashing, big red, and says debt card. Because they're purchasing something now and they're going to pay for it later. And when as later moves on, they're paying 19% interest. So I don't know how that, they're saying the consumer's strong when they're willing to pay 19% interest for an ice cream cone. I don't get it. So that's a big problem. And then the rest of the money, you know that they're pulling more money. Talk about cash out refis, pulling capital out to go spending, even larger than going back to 2006, 2007, before the 2008 crash. So the money is coming from, not from increased wages. And by the way, their wages are going down adjusted for inflation. Every time you get a paycheck, that paycheck is 9% less. Just like their boss took and said, I'm going to give you 9% less for your work. 9%. So their paycheck's going down 9%. They're paying 19% interest on their credit card. And they're cashing money out of their homes, and which now they have very low equity, and we're being told how strong they are. Are you kidding? But that's typical. The fake business news network, your Fox Business, and the rest of them. So they're in real trouble. But the banks, here's what nobody's talking about. The banks are in deep trouble. Deep trouble. Why? Because remember, for 13 years, the banks had this big ride because they drove interest rates down, the Fed down to zero. They were making a ton of money. But guess what's happened? That all stopped in November 2021 and January 2022. No more. QE stopped dead. And that's why the market started to crash. Leading was the tech stocks because, remember, rates started to go up because they had to fight inflation. So the banks have been taking a lot of their liquidity and setting it aside instead of lending it and making money for bad loans. They're in trouble. So banks have little liquidity. And all that cash is sitting over here anticipating all these defaults. And boy, defaults. Do we have defaults? Corporations, their debt is 300% more now, corporate debt, than it was when the market crashed in 2008. So the banks are in real deep trouble because they don't have liquidity. They can't go print it. And by the way, people aren't buying bonds. Bonds have been crashing, so they can't keep rates down. So rates are going up. Remember, another thing banks do is they'll borrow against their loans. That's right. When they loan you money, they got a big spread on it, and rates are going down, they borrow against it. They're losing big money. They're locked in. So, and also they're losing money because a lot of customers were locked in with fixed rates at 2.5%. Now those rates are 7%, 8%, 9%. Commercial loans, they're losing money. So the 15 largest banks with assets of about $23 trillion and net income of about $280 billion are in deep trouble. So there lies the truth. When you start hearing how great the economy is, how strong the consumers, they have all kinds of cash, everything's wonderful, the bottom's in, and they're going to stop with raising rates, or at least they're going to. Powell is going to stop with 75-point rate hikes. He's going to go down to 50, then 25. He may stop altogether because things are so wonderful. Everything we're getting out of Washington's a lie, and everything we get out of the Facebook news networks are a lie. The only way that you can make money in the market today, forget fundamentals. You can't trust fundamentals, okay? They're gone. They went the first day they introduced QE. The only way you can make money is following the money. We've been in a severe downtrend channel for 48 weeks. 48 weeks. We can't pull out of it. Because why? There's no more QE. So the market's going to, the market after January, see, they're trying to, from earnings season through Thanksgiving, they push the market up. And then they try to push it up going into the 5 days before Christmas, because that's when they start the Christmas rally, and it ends after January 2nd. So they're doing everything they can to rally this market. And people think, oh, hey, look at this. Everything's great. This market is going to drop, okay? It's going to go back to their lows, the original lows, and then they're going to go down another 20%. The only way that won't happen is Janet Yellen is now talking to Congress about, hey, we can't do any more QE with the Federal Reserve because the Federal Reserve, they don't have any room on their balance sheet. They went from $850 billion in treasuries up to $9 trillion. So why don't I take over? The Treasury Department will start doing QE. This is what they're talking about, to try to keep the market going up. Do you know what that will do to inflation? I thought they're supposed to be fighting inflation. Are you kidding me? It's not working. But my point is, things are going to get worse for those people who don't know how to sell short. That's right. So even if they do start QE again at Treasury rather than the Federal Reserve, okay, it's not going to work because we can't take any more inflation because wages are too far shot, okay? So you got to learn how to sell short. That's the only defense you have. And by the way, buy gold stocks. So try my gang. Go to philsgang.com for 10 days. You're going to learn more in 10 days than you learn at Wharton or Harvard or UCLA. Believe me, check it out. So that's it. So please have a great Thanksgiving, okay? And please be careful. See you on the charts, philsgang.com.